All right, Jerome Powell, he came and blessed us with his words. And this is absolute proof that short term is usually irrational. Look at this. The guy speaks. The market was even, basically. It's 3:19 p.m. right now. We're not even done with the day yet. And of course, I'm watching the NASDAQ because I have a short on the NASDAQ. It's up 3.5%. The Dow's up 1.5%, and the S&P is up 2.4%. All because he said one thing. We're probably going to decrease the pace of our rate increases. So 4 meetings in a row, they did 75 basis points, 0.75. Now that's insinuating that it'll be 0.5%. So November ends on a very strong note for the market. Very, very strong note. And it ends with Powell saying, look at how I'm going to sit there. He sits there and sees inflation still is an issue. People tend to ignore that. But he's saying we're going to decrease the rate. Now, I want everybody to remember, at the last meeting, I think they pretty much insinuated that was going to happen. A lot of people were saying that was going to happen. Whether they're right or wrong is completely different. But November was a very, very interesting month. The NASDAQ ended up 3.85%. But at one point to start the month, it was down 4%. S&P ended up 4.58% up. And by the way, this is an ongoing thing because how it finishes at the end of the day. So maybe it ends up being 4.7, whatever it ends up being. But it's around there. So what were the big events that happened in November? Did anybody hear about FTX failing? Anybody hear about that? That was a huge event that occurred in November. Huge event. Guys, if you've watched the channel, you know my view on crypto. If you're new to the channel, my view on crypto is it's fake. And I view it all the same garbage. The fact that there are many times more cryptocurrencies than actual worldwide currencies should tell you that crypto is absolute baloney. Now, in its current form, it is. Do I see some government out there, maybe whoever it is, saying, yes, we're going to make a cryptocurrency, it's going to be this? They're just going to do it because they believe that people out there are lemmings and they will buy into it. That's the only reason they're going to do it. Secondly, if you believe as a crypto bull that that's a good thing, remember the goal of crypto is to skirt government, but yet it hasn't been able to. All it takes is a government saying, a major government like the US saying we're not allowing crypto anymore, and then what happens? Remember why crypto was created. So FTX, the reason FTX is important is because it wasn't the first collapse in bankruptcy. The Winklevoss twins, who are big Bitcoin people, their Gemini is now having problems, and they sat there and said, hey, we're pausing withdrawals from people for a while. These are the things, and pardon me 1 second. Ooh, these are the things that are indicators of bubbles. Look at Bernie Madoff. Bernie Madoff wasn't the indication of a bubble, but his exposure showed how easy it is to get away with things when the markets keep going up. When there's long-term markets just keep going up and money's easy, you can get away with a lot of things. When you have everybody in the world believing in cryptocurrency, to the astute investor, they realize that should not happen. But to the average person, they see a glimmer of hope. They see a future that they believe puts them in the realm of everybody, all these other billionaires out there. Guys, it's just started. And this is after Bitcoin is down 70%. It's just starting. I personally do believe that cryptocurrencies will go down to zero in their present form. And the only form that it's going to take that makes me believe it can work is basically making a currency that's digital, which I do agree with Charlie Munger when he says we already have a digital currency. Because the whole point is to make it so discreet that it can't be traced. Why would a government ever allow that? Why in God's name would a government ever allow that? And all you had here was a bunch of young people like SBF out there doing completely stupid things with the money because money was easy. And when money becomes easy, guess what happens? Bubbles are formed, and then when they pop, it is disastrous. Okay, another thing. Existing home sales. This last month, it was 4.43 million units. The same month last year was 6.19 million. So down 28.5%. But why is that? Well, I'll tell you why. Last year in October, the month of October, the average 30-year mortgage was 3.14, and it's currently 6.58%. That's a big reason. If you have a $300,000 mortgage and you're paying 3.5% more money, how much is that? That's $10,500 extra a year. That's $900 extra a month, almost. That's the reason why home prices are suffering. Because look, the job numbers are still good. The GDP numbers are still good. We have inflation, which is the friend of real estate. Now, in fairness, inflation is really flatlined, which a lot of people like. You got to remember, if you're new to this channel, I want you to remember, I don't view many things as inherently in and of themselves good or bad. I look at things that happen and say, here are the good things from it, here are the bad things from it. Now, one of the good things about crypto, and I know this is going to sound crazy, some of the good things about bubbly markets is it's a good way to reset. Eventually there'll be a pop and there'll be a reset. Because in order to make stable highs and support, when you go like this, that's not healthy. You need to go like this to get more stable so you can grow normally again. That's what I want. That's what you should want as an investor. You don't want massive fluctuations. You should want steady growth based on good fundamentals. And that's what we teach on this channel. Everything I've said to you on this video so far has been very basic, but that's the way I like to keep it. I'm not trying to make it overly complicated. I try to draw a lot of analogies to your everyday life, right? And the reason I do that is the economy is basically your own world magnified by 330 million people. The more you borrow, the worse it's going to be for you. Well, this country is borrowing a lot of money. It's going to have to be paid at some point. And it's fine when interest rates are 0% to borrow a lot of money or 1.5%. Great, I'll borrow all day. But now you see a year ago, I was getting 0.06% on my 90-day treasuries. It's now 4.2%. So this basically meant I was giving the money to the government for free, which I was okay with. Now they're paying me 4.2% to have that money in their accounts. Okay, I'll take that. That's wonderful. That's a really good return. I'm really happy with that. Money sitting in cash getting 4.2. Now, here's the scary part. The 10-year treasury is 3.58% versus 90-day at 4.2, whatever the 90-day is right now. This is an inverted yield curve. Now, we usually look at 2 years versus 10 years, but the reason this is bad is the further you go out, the more interest you should be paid because there's more risk of things happening at that time. But here, the interest rate is higher during shorter periods. That means people perceive a short-term risk as much more likely than a long-term risk. And that's why everybody wonders if we're in a recession. Now, GDP growth has stayed up. I think it was 2.9% or something like that. Well, what's the bad side of that? Well, the bad side of that is it's inflationary. And that's what the Fed's worried about. Good news out of the economy might actually make the Fed want to increase rates, right? And the bad news about that, well, I don't know. Here's some other good news about it. Here's some good news about it. My stock market to GDP ratio. So the most reliable indicator of stock market values in the long run is the stock market GDP ratio. I created my own version using the S&P 500 and its equivalents going back to 1929. Now, based on where we were actually in October, we were 57.7% overvalued. Let's see, let's put in the data right now. We're currently at 4,056, call it 0.5. We're currently at 70% overvalued. So the market has jumped up in overvaluation in the last month. Now, the good thing about GDP growing so fast, though, is that GDP number is the denominator. The faster and faster this grows, the faster this drops. Look at it this way. Just a year and a half ago, we were at $22.7 trillion in GDP. Now, because of inflation, we're at 25.66. It made the rate go from, the overvaluation go from 106% and 107% down to 70%. So we still have a long way to go, but it's all working together. Because look at this. 1, 2, 3, 4, 5, 6 quarters, we did $3.5 trillion in growth. The previous 6 quarters, 1, 2, 3, 4, 5, 6, we did $500 billion in growth. So we did 6 times more, 7 times more in the last 6 quarters than we did in the previous 6 quarters. And that's what inflation does. It drives up GDP, drives up nominal prices, and can drive up your income over a long period of time. So in the temporary time being, you're going to feel a pinch because it takes a little bit longer to pay more money to people than it does for these things to work themselves out. Now, the thing I want to repeat over and over again, we will get through it. No matter what happens, the U.S. economy will end up stronger and better. The world will end up stronger and better no matter what happens. And that's what I'm trying to teach on this channel over and over. We do these recaps to remind people, yes, look at the data, but still follow the valuations like I'm doing here. Follow valuations, just be cautious. Say, listen, if you believe in dollar cost averaging, which is what I believe in for 99.9% of people, just realize you're going to have a bumpy road for the next 10 years. But it doesn't mean you shouldn't invest. You still want to invest because the market goes like this, but the prices go like this. But it's still going to go up over long periods of time. You dollar cost average along the way, and you will do well. You'll overpay and underpay at times, but overall, you'll pay exactly what the market's worth, and you won't have to waste your time thinking and overthinking. Don't worry about the day-to-day minutia. Don't worry if Fed Chairman Powell accidentally farted in the middle of his speech. It does not matter. What matters is this country going to be better 10, 20, 30 years from now than it is today? Yes, it probably will be in all likelihood. I can't say for sure because a lot of things are going to happen, but the way this country does not end up better is a way in which you won't even worry about your retirement accounts anyhow if that actually happens. Look at Great Britain. We are the number 1 country in the world. A lot of people are saying China will overtake us. Let's say that happens, which I'm okay with. Why? Because Great Britain was overtaken 200 years ago by us, and guess what? Great Britain's still a great country today and still grown tremendously in the last 200 years. Just because you're number 2 doesn't mean you're bad. We are a large country. We can't grow like we used to grow. Look at it this way. To double in size, let's go back to 1920. Let's go back to right here. 1940. We doubled in size in a matter of 3 years. All right? 3 years it took us to double in size. Nowadays, it took us how long to double in size? It took us 2004 to now. It took 18 years to double. Are we a worse country now than we were back in 1940? Come on. Of course not. Of course not. We're a larger country now. But this is what goes to show when I talk about companies. The larger and larger a company is, the harder it is to grow. That doesn't make them a bad company. It's just you have to realize you're going to get your returns from paying a low multiple. Same thing here. How you can get your returns here? Paying a low multiple of some sort of GDP ratio. That's why I have this up here. We are overpriced. The next 10 years will be painful. These returns are before dividends. Dividends are not included. The average rolling 10-year return is 6.6%. When we're undervalued, it's 9.3, which makes sense because you're paying less. When you're overvalued, it's 2.3. But the scary part is when you're 30% overvalued or more, the average is a loss of 0.1% a year. And we are 70% overvalued. Does that mean sell everything? No. What it means is still dollar cost average, still stick with your plan, but be ready for bumps. If you want to set aside 10 or 20% of your money to learn from us on how to invest in individual stocks, do so, but that's the place you should be holding your money tight and waiting for the right opportunity. And guess what? You won't get it right 100% in terms of the market bottom. You'll never, in my history, I can remember one time I bought at the bottom. One time out of hundreds and hundreds of investments I've made, one time I bought at the bottom. And guess what? I was upset that I bought at the bottom. I was hoping it was going to go down and it went straight up. And that annoyed me because I wanted to buy more shares. So guys, November was a great month for the market. Fed Chairman Powell ended the month well by saying we're gonna decrease our rate increases. Guess what? Higher rates are more to come. The U.S. economy, if it's in a recession, not in a recession, I don't know. But the bottom line is the last 10 years have been very, very good for the economy. The last 14 years have been very good for the economy. It's okay for there to be a break. Now, I understand it can affect people individually, and for that, I'm sorry. However, all the more reason to don't spend too much, live well within your means, and don't buy things you don't need, even when times are good. So please subscribe to the channel if you like what I've said. Even if you don't like what I've said, subscribe to the channel because my personality is really annoying and you're going to have a lot of fun with it. Thank you.